Now, the alternative to traditional property investing strategies are creative property investing strategies. And the reason we call them creative is because there is an element of thinking outside of the box when it came to putting these sorts of deals together. So we like to call them creative. The other beauty of creative investment strategies is because of the flexibility of the way they are set up, you really can continue to create your own set of requirements in order to achieve exactly what it is that you want to achieve. The reality with traditional property investing strategies is it's pretty straightforward. You buy the property, you let it out, or you flip it for profit. It is as simple as that. With creative strategies, there are so many variables that you can bring into what you're doing with those contracts that they are very flexible, and they are also great for generating quick cash flow, which is ultimately what I know a lot of you will be interested in. Now, there are various different types of creative investment strategy. The three that we're going to cover today are rent-to-rent, lease options, and assisted sales. All of them can be used in a variety of different ways. So I'm going to run through some of those with you today. So rent-to-rent is effectively where we take control of a property owner's asset, their property. We give them a fixed monthly amount for the privilege of having control of that asset. And then we take it, improve it, go out and find tenants for it. And then whatever the profit is, it becomes our cash flow on a monthly basis. What's important here is, of course, the more cash flow that you can generate, the less properties that you need. The less properties that you need means the less involved it's going to be in terms of property management. And of course, in an ideal scenario, you really want the minimal number of properties for the maximum amount of cash flow. The more properties you have, the more problems that you could get. The more problems that you get, the more chances there are of voids, arrears, maintenance, that sort of thing. So there are three different ways that we teach rent-to-rent. And then there's a fourth that I will cover, but it's not something that we teach ourselves here at Goliath. The first rent-to-rent model that we teach is the rent-to-rent single-let model. And it's as simple as we find a property that's currently let on a single-let basis to one tenancy. That might just be your standard 2-bed, 1-bed, 3-bed property to one family, couple, whatever it might be. We agree a price with the property owner, and then we rent it for a little bit more, and we keep that cash flow. Now, of course, if you're doing it that way, you're going to need a lot of those properties to generate a substantial amount of cash flow. So that is a bit of a flaw when it comes to the single-let rent-to-rent model. But what it does do is it allows you to get to grips with property management, tenant finding, the legal requirements that are required of you as a landlord as you are finding those people to put in those properties. So it's a great way to ease yourself into the property world, and single lets carry with them a little bit less risk than the multi-let strategies that we're about to come on to. Now, of course, by having to get a lot of them, it means that you may well think that we'll go for the bigger properties, the multi-let properties, which is the beauty of the next model, which is the single-let to multi-let model. And what you do with a single-let to multi-let is generally you take a property that is existing as a single-let and then you rent it out room by room. You may convert a living room into a bedroom. You may well find that there is a large double bedroom that you can split using a partition wall. There are all sorts of ways of turning a single-let into a multi-let. What you do have to consider, however, is there will be generally an additional refurbishment cost, not just from it making a space into a bedroom, but also from the regulatory requirements in terms of multi-letting. So room sizes, safety requirements, electrical safety, fire safety, and also you're going to have to consider exactly what product that property owner is currently on in terms of their mortgage product, because not many residential buy-to-let mortgages will then allow multi-letting. So you may well find that the property has to have its mortgage product changed, which means that you're going to have to get the landlord to do that, which can add some extra cost, which you may well have to factor into that guaranteed rent model. Now, this is the beauty of working with a mortgage advisor. You can get them to speak with that property owner and get them transferred over to a product as easy as pie. Now, clearly, because of this extra space that you're getting from the single let model, what that means is that the cash flow on these properties is probably the best cash flow out of the three models that I'm going to run through with you today. Now, the third model is the rent-to-rent existing multi-let model, the existing HMO. And it sounds exactly as it says on the tin. What you do is you find existing HMOs, multi-lets, you offer that property owner a guaranteed rent that is pretty much just a little bit shaved off what they're getting net rent at the moment. And then you improve it through refurbishment, through finding different types of tenants. Maybe the landlord just wasn't motivated and you can keep the occupancy levels much higher. You're going to get much more profit. The difference between the single let to multi-let and the existing multi-let model is that the property owner has already experienced rental income at the level a multi-let generates. So what that means is they're going to be less likely to reduce massively, so the cash flow that you get is likely to be less. Of course, the flip of that is that the property is likely to already be ready for multi-letting. It's going to have a history of multi-letting. It's probably going to be in an area where multi-lets are in desire and demand, and that's going to make things slightly easier for you in terms of finding tenants and getting rooms filled. Now, multi-lets, HMOs do come with their challenges. What you're effectively doing when you look at a multi-let is you're taking on if it's a 5-bed multi-let, the way that you manage those properties can often mean that it's the equivalent to taking 5 separate properties on at any given time. You're going to be dealing with 5 individuals. You're going to be dealing with the wear and tear of those 5 being in and out of that property all the time. And you tend to find that the wear and tear is much higher than it would be on a single let property. Wear and tear being higher means that there's going to be an increased maintenance cost. So you need to factor that into the numbers so that you know that you're going to be able to do a lot more in terms of touching up when tenants move out, for the new tenants to come in, to maintain that room let level so that you don't start losing out on your monthly cash flow. Now, the fourth model of the rent-to-rent strategy, which we don't teach, but it is a model for you to consider, is the rent to serviced accommodation model. Now, I'll tell you exactly why we don't teach it at Goliath Sourcing Academy. The rent to serviced accommodation model is fraught with risk and danger because of the way that they are set up with property owners. More often than not, the issue with a service accommodation model is that the service accommodation is a business, which means that the property is being run as a business, a short stay accommodation business, which means that more often than not, a buy-to-let product that is already on that existing property is not going to cover the use of that property as a short stay accommodation business, which means that if the mortgage company were to find out, having you not told them, and the landlord, the property owner, not changing their contracts, then there is a chance that they may stop you from running that as a service accommodation model, and you could be left with a dud that you can't let out on a single let basis, and you've already offered that property owner a higher than normal amount because of the promises of larger cash flow. Because of course, running a short stay accommodation property means that you are going to be charging nightly or weekly, which of course is going to bring with it its premium. But what that is offset by, of course, is that you've got to maintain the occupancy levels. You've got to ensure that it is as full as possible, as regularly as possible, in order to keep that cash flow going. You're also potentially going to be hit with seasons. You're going to be dependent on who it is that you're targeting. So there's all these various things to consider, and that is why it's a model that we don't particularly like. We like holiday lets as a purchase to holiday let, but the rent to service accommodation model we don't personally believe is worth the risk unless you can agree a particularly low rent just to offset the chance that it may well have to be returned to a single let property, and all permissions must be sought from leaseholders, from mortgage companies, from anyone else involved with that property in order to make sure it is all above board. So that is the rent to rent model. Now, the next creative strategy that we're going to be talking about is the lease option strategy. Now, with a lease option, it's kind of a little bit of an extension from the rent-to-rent model. The slight difference now is that you have the option to purchase that property at some point in the future that you agree now for a pre-agreed price. Now, that price might be the current market value today. It might be a predicted market value for the future. That's very dangerous, so I would certainly never recommend doing that. Or it may even be a reduced price now, just because you can then share any equity at a later stage when you exercise that option. Like I said at the beginning of the video, the flexibility and the creativity that you can have with these contracts is endless. So you can agree to share equity, you can agree to not have any equity, and all of these things you can do with the vendor to make sure that it is a win-win so that everyone is happy at all stages of that agreement. Now, during the option contract, what you're going to have is a monthly payment that you're going to pay to that property owner, similar to the guaranteed rent amount. And then what you're going to do is you're going to either let that out, or you may well refurbish it and flip it on, which is the assisted sale strategy, which I'll come on to in just a second. So with the lease option, what you can do is that you do have more control over that asset's capital appreciation, the price going up with the work that you do to it. The reason being is that you've agreed an option to purchase price now. So any works that you do to that property that increase its value, you or someone that you package that deal up for is going to benefit from that capital appreciation. So it's almost that slightly better rent-to-rent agreement for negotiating with those property owners. Now, the other good thing about lease options is that they are always going to be carried out by solicitors. We would always recommend getting solicitors to take part on both sides, so your side and the property owner's side. Reason being, we don't want any issues in the future when that property shoots up in value because you've sourced a great property in a great area that you know is going to increase in value. What you don't want is for that property owner to come back and tell the lawyers that they were under duress, that they felt forced into that agreement, and then it was rendered null and void. So by having both parties represented by legal professionals, solicitors that know what they're doing, that is going to stop that from happening at some point in the future. And to be fair, if you are agreeing a win-win deal now, the chances of that happening in the future are also very slim. So that's lease options. The next stage, what I want to discuss are assisted sales. And what assisted sales are is a bit of a hybrid between lease options and flips. So what you do with an assisted sale is, rather than actually buying the property to refurbish and sell, what you're able to do is avoid all the traditional purchase costs, which is what we're talking about with the creative strategies. And what you can do is you can do the refurbishment works. You effectively joint venture with that property owner. You do the refurbishment works. You sell that property on. You agree a price with the property owner, which is your option to purchase price. Then you sell that on for profit. You recover your refurbishment costs, your holding costs, any legal costs, etc. And then any of that profit is either 100% yours. It might well be something that you split with the property owner, and it's up to you again with regards to the creativity that you use and the win-win that you find, and the exit. You might go for first-time buyers, you might go for other investors. You can actually go for larger properties because, of course, you need less capital in order to get those deals done. And remember, all of this can be done with investors' capital as well. So those are the creative strategies. As you can see, we're massive fans of creative property investing. The reason being is the flexibility and the ability to really get those win-win situations for yourself and also the property owner. Just think, having an agreement where you can go to a property owner and promise them full market value or as close to full market value as possible, because you don't have to go through all of the buying costs that are associated with those traditional property investing methods. So those are creative strategies. Hopefully now you can see the difference and the benefits of creative versus traditional. You're never going to own the asset until you exercise the option, and the exercising of the option is a traditional purchase. So until then, you don't technically own the assets, but you are controlling them. But that's the beauty. You can get in really quickly. You can build up a very big portfolio quite quickly of those lease options rent to rents to generate that cash flow target figure that you're looking for to be able to do the lifestyle and the financial stuff of your lifestyle choices. And that is creative property investing strategies.